Good afternoon, everyone. Welcome to Marmore's webinar series. My name is Rakesh Khanna, and I work as an analyst with Marmore Media Intelligence. Marmore is a majority-owned subsidiary of Kuwait Financial Center, Marcus, established in 2010. Marmore has developed full-fledged research capabilities covering multiple areas such as infrastructure research, economic research, capital market studies, and policy analysis. We are focused on the MENA region, and we also serve the interdisciplinary knowledge needs of its clients and stakeholders. Today, we look at Bitcoin, blockchain, and crypto bubbles. Questions can be asked anytime during the course of the webinar, and it will be addressed at the end of the presentation. A recording will be sent in a day or two and uploaded in Marmore's website and its YouTube channel as well. So questions can be emailed at rkhanna@emarmore.com. I'll spell it out for you. It's rkhanna@e-marmore.com. So Bitcoin and blockchain have had an eventful year in 2017. It's been almost a decade since Bitcoin came into existence. Satoshi Nakamoto, the faceless creator of Bitcoin, he still remains a mystery, but the phenomenon that he has created has been nothing short of spectacular. Blockchain, the basement on which the Bitcoin network works, is actually touted as a panacea of solving institutional inefficiencies and vulnerabilities. Bitcoin, for its part, has risen from relative obscurity of the internet and has become mainstream now. So in this episode, we intend to brush upon the fundamentals of blockchain, Bitcoin, and other cryptocurrencies that have mushroomed since the debut of Bitcoin. First, we'll look at the dynamics of blockchain, a technology that has caught the attention of global governments and corporates alike with its utility value. You might be asking, yes, we have been seeing this in the news. So what really is blockchain? Well, let us look at what blockchain really is through an example. Let us imagine how a banking transaction works today. You need to transfer your funds from your account to your wife's account. What do? You log into your net banking account and place a request on the bank's server. The bank then authenticates the transaction. It looks at your balance and your credentials, and if there is a match, it does the transfer. Your wife receives the funds, right? So let's have a look at how this works in the Bitcoin and blockchain network. So current system of fund transfer and other activities, they depend on centralized networks and centralized servers to do the transaction. Blockchain, however, turns this concept on its head. Instead of having a centralized location that serves as a point for retrieving information, blockchain distributes the information across its network. So when a similar transaction is initiated via the blockchain network, all of the users of the transaction validate that this particular user A has sufficient balance to transfer his funds to user B. But this is where the blockchain network operates slightly differently when compared to a banking transaction. After this validation, the blockchain network, the computers that are there in the blockchain network, they scramble to solve a cryptographic puzzle. Solving the cryptographic puzzle, in turn, adds a ledger block. Okay, so this is a step that adds immutable security to blockchain. This is what you read in the news, that blockchain cannot be hacked. That is because of the cryptographic key that is present in the blockchain. So once one of the computer in the network solves the cryptographic puzzle, it distributes or it sends out the message saying that, yes, I have solved the cryptographic puzzle and here is the answer to it. So all of the computers in the network, what they do is they validate that this cryptographic puzzle has been derived in ways that are compliant with the framework of blockchain. And once they found that this cryptographic puzzle is indeed correct, they record the transaction. As a reward for solving the cryptographic puzzle, the miner receives the Bitcoin. The process starts again for the next transaction. With each subsequent transaction, the intensity of the puzzle increases. This is in order to compensate for the increased processor speed. Okay, so So in the eve of these Bitcoin, there are also other Bitcoin clones that have arisen. The alternate coin market, as they are called, has seen more than 700 currencies. Research suggests that for there is even a currency that's built on a popular meme. Almost all of the alternate coins, take Bitcoin's code, which is open source, modify it, and suit it to their needs. What they do is they compile it into the files and they release it to the public. The ones that you've seen in the list are the ones that have been the most successful after Bitcoin. Litecoin, for example, was set up as some of the users of Bitcoin were not very happy with the rigidity of the rules surrounding the Bitcoin. Even Bitcoin itself has forked twice and resulted in two new digital currencies called Bitcoin Gold and Bitcoin Cash. So, what do you mean by forking? Well, what happens is when a certain section of the Bitcoin users are not happy with the rules that govern or any other cryptocurrency, when a certain section of the users are not very happy with the rules that govern the particular currency, they usually go for hard fork. So what happens is, till X point in time, the old rules apply. After X point in time, the new rule applies. But this new rule is applicable only to newly generated cryptocurrencies. The older cryptocurrencies, or the people who are happy with that those previous rules, they continue the same rules, while the new people, they receive new Bitcoins in their account. There's even a coin that started as a joke. It's called Dogecoin. That's based on a very popular meme that has got a funny picture of a dog on it. Well, it's not very funny when you look at it. It's got a market cap of 1 billion. That's not a joke. What has caused such deluge of alternate coins, you ask? Well, the technology behind it would be the answer. Blockchain is a digital world equivalent of say X. Now you could use it to make simple sunny side up or more difficult souffle. A souffle here being the deployment of blockchain in areas that such as healthcare records, recording healthcare data, insurance data, and loyalty point collection and redemption, etc. Now, blockchain can be deployed in all these areas, but they're still in the experimental phase. None of the blockchain application has been deployed in these areas. So blockchain has that potential to develop into a well-made souffle, but it needs other vital ingredients in order to achieve that. Dubai aims to use this technology in everything from real estate, visa issuances, financial transactions, and even utility bill payments. And that has given a major fillip to other governments looking at blockchain, using them in their applications as well. But given the logistics and cost involved in all this, issuing coin takes only a fraction of that cost, and it also helps in retaining the user base who need a reward for the computing power that they supply in for maintaining the alternate currency network. So creating an alternative currency is easy. Maintaining the network is a different ball game altogether. You need a very active participation from the development community to solve the issues very quickly, and in order for the network to continue working flawlessly. So how do you get people? How do people get hold of Bitcoins? Well, there are two ways in which one can pocket Bitcoins. Mining is one popular way. The one that you see in this slide is a very popular Bitcoin mining rig. It's called Antminer S7. Well, this should in no way be considered as an endorsement for the product, but this is just one of the very popular miners that's available in the market. Okay, mining is usually done through very specialized rigs. When initially the mining started, it was done using normal desktop PCs, but once the cryptographic bubble started becoming very tough to crack, the computing power of desktop PCs were just not enough. So people started to switch to this ASIC technology, which is called application specific integrated circuit. So all these Bitcoin mining rigs, they come in a wide variety of shapes, speed, electricity consumption, etc. However, it is not recommended. It's not the most recommended way to get hold of Bitcoins. Why? Because not that the ASIC machines are super expensive, but there's been a computational arms race of sorts that has resulted in huge, big companies deploying arrays and arrays of ASICs to mine bitcoins. So what happens is, added to this fact is that the blockchain protocol, it gets difficult progressively. So and there's also this electricity cost that you need to look into. So all this kind of makes Bitcoin mining an unviable option for a general hobbyist user. It's better that there and give there is another important thing that one needs to take into consideration when mining the bitcoins. The Chinese have taken to mining with huge interest, and given the electricity cost over there, which is pretty cheap, this has been very profitable to them, and it's very difficult for anyone from other countries to compete with those people. There are other ways to mine bitcoin. You can do it by signing through cloud mining or paying a warehouse a subscription fee to buy a space for your machine. You can do that. You can There are services that provide warehouses. So what they do is they pool in all the resources of different people who are interested in mining, and they host all these mining rigs in their warehouses. They take care of the electricity, take care of the upkeep, they take care of the network maintenance. What you pay in return is just the upkeep fee, a subscription fee. Okay. So there are also other ways to buy bitcoins. You can buy it through direct trade. This involves an agreement between buyer and seller, similar to how you buy things on auction sites. There are peer-to-peer websites. Peer-to-peer websites allow people to purchase goods on behalf of them, and the buyer then pays his reseller with bitcoins instead of US dollars or Canadian dollars or whatever fiat currency that he is willing. There are exchanges. Exchanges are the more direct way and the most popular way of buying bitcoins. You can sign up with them, register your credit card, pay for the bitcoin at the prevailing rate, and buy it. Storing these bitcoins can be done online or through offline channels. So online wallets, as they are called, are secure for most of the part. But there has been a lot of recent hacks that has led to a lot of bitcoins being lost in the network. People have lost millions of dollars. People there has been quite a bit of apprehension in storing bitcoin securely online. So people who don't want to store their bitcoin keys online can look at offline wallets. These are hard drives that are specifically designed for storing the private keys of bitcoins. Private keys in this context is like a password of varying lengths. You need a private key to access your bitcoins and to transfer them. Uh, so this is grateful theory at work. Yeah. So we have seen that in the past few days, the value of Bitcoin has been subject to pretty wild things, and this even has got a lot of spillover effect in the alternate coin market as well. So Bitcoin started out as an utopian experiment that was aimed at solving the problems with fiat money. And fiat money has got a huge number of mechanics that go on to put the trust of that fiat currencies. For example, there needs to be a huge amount of coordination between central banks, the treasury, and the government, and these always cost money and they are not always explicit. But the palpable enthusiasm with which Bitcoin is trading now seems to undermine all these qualities that made it appealing in the first place. And now risk being merely seen as a speculative investment that could very well turn into a bubble. A huge portion of enthusiasm for Bitcoin has poured into alternative market, coin market as well. That has, in turn, raised the prices of other Bitcoin clones. Its closest competitors like Litecoin, Ethereum, Monero, etc., um, have witnessed similar price movements in the past few days. So, are Bitcoins above? Let us get straight to the point. Conventional valuation methods can't be used to value Bitcoins. They just don't fit into the world of Bitcoin conventional investments. So, how do you value an investment when there exists no framework? You can't. Then please don't bother trying. You could very well end up second guessing the market and lose a lot of money in the process. Renowned finance professor Mr. Damodar, he suggests pricing the Bitcoin like any other currencies. But that brings us to the next question: is Bitcoin a currency? Well, in order to serve as a currency, a currency should serve three major, should fit three major factors. It should be a good medium of exchange. It should serve as a good unit of account, and it should serve as a good store of value. Well, let us first look at the medium of exchange part. Well, there are very few legitimate establishments around the world that accept Bitcoin as payments, mainly because even if they're going to bill in Bitcoins, they have to pay taxes only in fiat currencies. No government around the world accepts actual tax payments in Bitcoins. So currently it remains more of a novelty rather than mainstream payment option. Uh, Second is unit of account. It does not serve as a good unit of account either. The underlying problem here is that prices of Bitcoin has varied so much so that no establishment wants to accept a payment whose value is constantly fluctuating. And no investor wants to pay with Bitcoin and lose its potential upside. Third one, store of value. Well, fiat currencies have prided themselves on the fact that they act as a very reliable storage of value, paring the day-to-day fluctuations. A 50% drop in fiat currency would occur only during times of war or a catastrophe. But we have seen such movements in Bitcoin, and it's pretty normal. It's pretty kosher in the Bitcoin world. So it ultimately fails all the three tests of a currency. And with no clear-cut way to establish valuation using fundamental parameters and no observable relationship with the economic or other parameters, Bitcoin has been able to sustain itself only backed by investors' interest. And if the past crisis has taught us anything, it is this: all bubbles are alike in eating up investors' wealth. Thank you. Thank you very much. We are now will be taking questions for the next 10 minutes. In case you want to send your questions, you can send these questions at rkhanna@emarmore.com. I'll spell it out for you. It's rkhanna@emarmore.com. Well, we have a question from one of our listeners. Is Bitcoin in a bubble? Well, yes, we do feel that Bitcoin is in a big bubble, but we really don't know when this bubble is going to burst. Mainly because it most of the Bitcoin's appreciation has hinged upon this higher investors' interest. People who didn't really catch on the Bitcoin phenomenon early wants to play catch up. That's why people are just pouring money into the Bitcoin market and really don't know when that money is going to stop. So yes, it's in a bubble. We have another question from one of the listeners. Is Bitcoin mining an attractive proposition in the GCC region, considering the availability of cheap electricity? Well, it's an interesting question, given that China and GCC region both have very cheap availability of electricity. Well, electricity factor is just one of the consideration when we look at Bitcoin mining. There are what we have to know is that an individual who's actually going to mine Bitcoin is going against people who own server farms. So they have arrays and arrays of machines that do these things on a daily basis. And given that almost 80% of the bitcoins has been mined already, the cryptographic puzzle is only going to get more tougher, and it's going to be more challenging for a hobbyist or an individual to really, profitably mine bitcoins. So yes, people with enough deep pockets can do it, but we really don't recommend it. We have another very interesting question now. Can you invest in cryptocurrencies through market instruments such as ETFs? Uh, well, I think it would make a very interesting product if it's going to come into existence. But I don't think really think there has been any company that has issued such an instrument. So, as far as my knowledge, I don't think we have such an option. Well, we have another question over here. In case the bubble bursts, what sort of impact the bubble will cause, and who will be the most affected? Well, the one good thing about a Bitcoin mining is that almost 90% of the Bitcoin is concentrated in very few thousand wallets. So these are the investors who will be directly facing, they will be facing the highest impact of these Bitcoin bubble bursting. And the other impact or the collateral damage would be for companies that are in the business of selling Bitcoin mining rigs or Bitcoin networks, as well as exchanges that sell Bitcoins, as well as these online and offline Bitcoin wallet providers. So these people will be now. What has happened is the rise of Bitcoin has also created the ecosystem of the above mentioned people. So these people will be most impacted. Suppose that this bubble should this bubble burst. Well, we have one more very interesting question. Mm, One last, will the regulators' stance on cryptocurrencies affect it? We have many central banks and regulators are banning them. Well, yes, there has been a lot of action from the regulatory authorities banning the sale or purchase of bitcoins. Well, they have reasons to worry. So because what has happened is Bitcoin has now gone mainstream and it slowly started to attract individual investors or individuals who don't really have that deep pockets who can really take a big loss. So yes, the regulators are worried that the cryptocurrency bubble might even result in these people losing their hard-earned wealth. Yes, there will definitely be some impact of the regulators banning regulators banning these cryptocurrencies, but it is really very hard to measure given that the market is in a bit of a frenzy now. One day it goes down by 20-30%, and the next day it's up. So it really depends on uh, the investor's interest on that particular day. Well, that's it for today. If you have any more questions, you can email those questions at rkhanna@emarmore.com. Alternatively, you can also send in your queries at enquiry@e-marmore.com. We'd be very happy to address whatever queries that you might have regarding this particular webinar. This recording will also be available in a day or two on our website and through our YouTube channel. Thank you very much.